welcome to the second webinar of our State Conference Rewind series. We're all so glad you're here to join us. Our presenter today is Bob Becker. Bob is the owner and president of R.D. Becker Valuation, LLC, which focuses on large-scale industrial, commercial, and agricultural properties. Bob holds a certified general license in Illinois, Indiana, Missouri, and Kansas. He holds the Appraisal Institute's MAI, SRA, and AIS-GRS designations. He also holds the American Society of Appraisers ASA designation. In addition to the premier designations, he holds a Bachelor of Science degree in finance from Eastern Illinois University, and he is also a course instructor and course writer for us here at the IPAI. So everyone, please welcome Bob.
Thanks, Amanda. Welcome everybody today. Hope you'll enjoy the presentation today. A little bit of background, I guess, about it is when I was thinking of something to do for the 2025 state conference, I understood that a lot of people, assessment officials, will have appraisals brought into their office that may not necessarily be for tax appeal or ad valorem type valuation. And so what I wanted to do is kind of take you through the steps that the appraiser would consider when developing an appraisal, from initially contacting the client all the way up to the development process. And with that information, then you would have a better understanding whether it would be something that you could rely on within your office, because maybe the appraisal wasn't necessarily developed for ad valorem, but yeah, it still meets the criteria as far as market value, fee simple, those kind of things that would allow you to still put some weight on it. So, so first we want to understand, what the appraisal report is. Is the appraisal process. Ultimately, the appraisal report varies from simplistic to very complex. There's a number of users that rely on the appraisal process. Each user requires different questions to be asked during the valuation. Many of the reports answer the same questions, but answer very different, but some can answer very different questions. For ad valorem, it's important to understand the subtle differences. Okay, so what is an appraisal? So USPAP is the organization that all appraisers work under. It's a uniform standard of appraisal practice, professional appraisal practice, and it's a government entity that basically sets the ethics of what we have to work under in the requirements. So they define an appraisal as the act or process of developing an opinion of value. It goes on to say an opinion of value of or pertaining to appraising and related functions such as appraisal practice or appraisal services. So what is a appraisal report then? It's basically communication of those appraisal assignment. So when we talk about value, apologize about that. I've been getting the bean dust in the air last few days. So there are many types of value that appraiser can look at, right? We can answer about any question about value that you want answered. We just have to know the question that you're asking, right? So types of value include market value. So for ad valorem, obviously we're going to be concerned about market value. For financing, we're going to be concerned about market value. Market value basically means that the property has a willing buyer and seller. It's been exposed to the market for a reasonable amount of time, and there's no undue influence from either side. We can answer the question of assessed value. Again, in Illinois, we are going to take the market value and we're going to apply a certain assessment ratio. right? Most of the time, downstate, outside of Cook County, that's 1/3 of market value, right? And then if you get into Cook County, those assessment ratios vary a little bit differently. Now, if you get into states like Indiana that require a market value in use, an assessed value may be slightly different than just applying the assessment ratio by the market value. A replacement value, again, so this would be a cost or a value to reconstruct the property using modern materials and modern craftsmanship. Insurable value, this would be again, if you have a insurance company that is needing a value, if you have less than replacement value, such as actual cash value, they may ask an appraiser to do an appraisal for the insurable value based on some criteria of the insurance policy. Investment value is one where the investor that's hiring the appraiser sets certain criteria that may not be market value, right? So I could have an investor call me up and say, I want you to value this apartment building using a 7% cap rate. So part of my assignment conditions is I'm going to use that 7% cap rate. That's because that's what the investor required. And I'm going to come up with a value. Liquidation value. This is more commonly found in either relocation assignments where a individual works for a company and the company is handling relocating them for job purposes, and they're handling the sale of the property. And typically what they're going to ask you for a liquidation value is they're going to define the amount of time. So they're going to say, okay, give me a value that I can sell this property within 10 days, or give me a value that I can sell this within 30 days. But basically, the liquidation value represents a time shorter than a typical marketing period. Fair market value, that's often used in the assessment world, but basically market value and fair market value are going to be synonymous. Going concern value, this is a value that has that's related to a property type that has a business value intertwined in it. So when you think of going concern values, it'd be hotels, convenience stores, sometimes car washes, those types of buildings that are specifically constructed for the business enterprise. And so the going concern value would be the market value of the real estate plus the market value of any furniture, fixture, and equipment, plus the market value of any intangibles or business value. So in Illinois, most real property must be assessed based on market value. Illinois property tax code uses fair cash value. And they basically define that as a willing seller that's not compelled to sell, and a buyer that's not compelled to buy come together after typical marketing. So again, looking at some of these values here, replacement value is definitely something less than market value. Insurable value is going to be definitely something different than market value. Now, investment value may or may not represent market value, depending. If the investor says, I need an appraisal done assuming 7% cap rate, but the market cap rate at that time is 7%, then the appraisal probably does still represent market value. Liquidation value is almost never going to represent market value because of marketing time is an issue. And depending on how the going concern value is allocated, that will determine if part of that can be used as market value. Sometimes going concern value is just reported as one value, and so it has the real estate, the FF&E, and the intangibles all intertwined into one value. And that's not going to be very helpful to determine what the real estate portion of that value is. Other times, the going concern value will have each item allocated out. And so if the real estate portion is allocated out, then that would be something that you could rely on. So then once we determine what type of value that we're going to develop, we need to know what the purpose of the appraisal is. So obviously, ad valorem, right? That's why we're all here today is for ad valorem use. Buying and selling transactions. You may have a situation where there's no mortgage involved, but say a buyer is out in New York and they're wanting to purchase an apartment building in Champaign, Illinois, and they're not really, the numbers look good on the information that they looked at, but they really don't know if they can believe those numbers. And so they may hire a local appraiser um, to value it for them in the buying process, just to make sure that the numbers reported in the documentation they were provided is accurate. On the other side, the selling side of it, you could have an individual that has operated a business in a location. They're really business savvy. They know what they're doing operating their business, but maybe they don't really have any idea on the real estate side of it. So they may hire an appraiser to help them set a value to sell it. Sometimes in a situation like this too, where there's no financing involved, a buyer or seller may hire an appraiser for an allocation. So if there's FF&E involved, so say again, back going to the hotel appraisals, you have three components. The buyer, the seller wants to get a firm handle on what the real estate portion of that is for tax purposes. They may hire an appraiser to help them set value that way. Mortgage lending, obviously, that's the most most common type of appraisal. And for residential appraisal, most of the time, this is going to represent the fee simple market value, right? So if you have somebody on the residential side that has recently got an appraisal for mortgage lending, and they come in and say, "Hey, here's what it appraised at," that's going to be pretty close to the definition of market value that we use when setting value for assessment purposes. Now, for the commercial and industrial, that's probably not true, just because you get into the lease fee simple issue. Another potential purpose of an appraisal is an estate settlement, either if they want appraisals for, say they're a high net worth individual that has to pay estate taxes. They may have to have everything appraised for the IRS. Or it could be as simple as if they have some property, they need something, some of that property appraised in order to divvy up the estate. Right. So again, on most of those situations, those are going to represent a market value type of value. Litigation and dispute resolution. So there's all kinds of reasons why that appraiser would be needed for litigation or dispute resolution. Each of these situations, you would have to take a deep dive into it to make sure that the appraisal is a market value appraisal and it represents the fee simple interest. Again, it's so broad that it's kind of hard to give generalities with that. Investment analysis. Again, if you have a investor from out of the area, wanting to make a purchase decision, it may have an appraisal done. Some large REIT portfolios have to have appraisals done every quarter on their properties in order to, it's called mark the market, to make sure that they have the assets that they claim they have. Again, you would need to take a look at each one of these situations to see if it does represent fee simple market value. Most of the investment analysis that the REITs do and the big equity firms do is going to represent a least fee interest. Eminent domain. So the way eminent domain is done is you're going to have a fee simple market value of the property done as if the right of way taking or whatever's coming through to take the property, you're going to assume that that is not happening, and then you're also going to develop a value as if the taking is complete, and then you're going to calculate some damages and some compensation to that owner for what's taken. Now, if if a value is done for eminent domain and it's done prior to the your 1/1 valuation, and the eminent domain taking has not occurred at that point, then the as is value may be something applicable that you could use. Or on the alternative is, if the right of way taking is done, they've built the new road, taken the easement from the property owner, and you have the appraisal that represents the after taking value, that may be something that you could rely on. Again, I would say kind of tread lightly on the eminent domain appraisals, just because there's so many other factors that go into it. Next one's charitable donations. This one, again, probably one that you want to avoid, just because there's a couple schools of thought. The client is typically motivated to get the value up as high as they can. So basically what the charitable donation is, say a person owns a piece of property and they want to donate it to a nonprofit, and they anticipate to deduct that from their property taxes or from their income taxes. Then they have to get an appraisal. It has to be submitted to the IRS. And again, there's a lot of games that are typically played with appraisals done for charitable donations. So so here's the initial steps in the appraisal process. We kind of talked about identifying the intended use and type of value. One important thing too is identify the client and intended users. A lot of times I see in appraisals and / appraisal reviews is that the intended user seems to be an issue. Is a lot of people are under a lot of non-appraisers are under the assumption that in order for them to use the appraisal or to rely on the appraisal, they have to be listed as a intended user. The way USPAP sets this up is the intended user is just an extension of the client. So say if you called me up and said, hey, Bob, we're having an issue with a difficult property here in the area. We need you to do the appraisal. Okay, well, then you become the client. And if you tell me that, hey, also, I would like the board of review to be able to talk to you, during the development of this appraisal process. Okay, perfect. So then I would identify you and the board of review, you as the client, again, you be one client, and then the board of review as the intended user. However, when we engage in this situation, I know that there's other people that may take a look at the appraisal, right? There may be ultimately the Illinois Property Tax Appeal Board, maybe the appellate court, heck, maybe even the Illinois Supreme Court, if it gets that far. But those may rely on the appraisal, but they're not necessarily my direct clients, and so they do not get named as intended users. Same way from the other side, say a taxpayer brings in an appraisal, you don't have to be named necessarily specifically. The board of review does not have to be named specifically as an intended user. PTAB does not have to be named specifically as an intended user. Again, that's just a function of who is engaging the appraiser. So, so then after we've identified all those, we have the effective date, which is generally for our purposes going to be January 1st of the lien date. Again, if you get an appraisal that comes in that's um, done in July for lending purposes for a single family residential property, and it's stable trend, it's probably reasonable enough to consider that. Identify relevant characteristics of the property. This is going to be from the initial phone call with the client. Specific site details will be further in the appraisal process. And then identify any assignment conditions. So let's talk a few minutes about assignment conditions. So we have general assumptions, and these are going to be things that we put in the appraisal every single time to protect ourselves. So one's going to be, um, I assume that this site is free of any environmental conditions, right? And the thing about the general assumptions is, if found true, could greatly alter the value that I reconcile, right? And so it's important when you're looking at appraisal to look through these assumptions to make sure that they didn't assume away anything so egregious that it detracts from a fee simple market value for ad valorem purposes. Hypothetical conditions. Basically, hypothetical conditions are lies. We know that it's one thing exists, but for the appraisal, we're assuming something else. So, and oftentimes appraisers get these mixed up. Hypothetical condition, and the next one is extraordinary assumption. Extraordinary assumptions are we don't know if they're true or false, right? So, but we're making this assumption for the appraisal um, going forward. And again, if they're found to be true or false, whichever way, it may impact the assignment conditions. So it's really important to look at these two, hypothetical and extraordinary, to make sure that there's something not just so egregious that it takes away the credibility of the appraisal report. Jurisdictional exceptions are exceptions that where court requires you to do something in the appraisal process. In right-of-way work, there are a tremendous amount of jurisdictional exceptions, but outside of that, there's generally not a huge amount. Laws or other regulations and other conditions. So let's take a look at some of these. So again, the appraiser does not choose to apply these in the assignment. They're driven by the problem to be solved. So here's some examples. General assumption is I'm going to assume that the property has no environmental hazards. I'm going to develop my whole appraisal based on that assumption. And if it does have some environmental hazards, then it's going to change the value of the appraisal. Hypothetical conditions. So say I have a developer that wants me to assume that the zoning is going to be commercial when it's currently agriculture. Say he's talked to local zoning board, he's talked to local city council, local city manager, whatever, and he firmly believes that he can get the zoning changed, and he wants to develop a retail district. So in my appraisal report, I'm going to assume that it's commercial, and I'm going to develop an appraisal based on that. How that may affect um, a value if they bring that in for tax purposes is if for tax purposes, as of the lien date, we have to look at what it actually is, right? So if you have an appraisal comes in that has a hypothetical condition and assuming that it's commercial zoning, it's not really going to do you a whole lot of good whenever the current use is agriculture, right? Extraordinary assumptions. The appraisal assumes the property is hooked to municipal water source when the appraiser has not verified it to be true. This happens a lot out again in the residential areas and the rural areas because you have rural water sources, rural water co-ops running throughout the countryside, and maybe for some reason the farmer at the time, generally when they come through, um, they offer you a pretty cheap discount to connect to their water source. But then if you don't do it at that time, then it becomes pretty expensive. And so sometimes when these rural water sources came through, the farmers chose not to connect onto it because they just like their well water better. So if you have an appraiser that then comes in, appraises the property, based on that it's hooked to municipal water, although they don't know. So jurisdictional exceptions. So in condemnation, again, use of federal condemnation laws over certain parts of USPAP. So laws and regulations. So um, the main one that we use, right, in property tax appeal is Springfield Marine Bank versus Property Tax Appeal Board. Basically, Springfield Marine Bank says that when developing appraisal using the income approach, we have to consider the market rents of the property and not the contract rents of the property. And finally, the other condition would be property rights appraised. So are we appraising the fee simple rights, or are we appraising the lease fee rights? So then the next step is, once after all this gets done, then so if we've outlined that we're doing an appraisal on market value, there's just basic general assumptions. Say there's no hypothetical or extraordinary assumptions that we're doing. And we know for tax appeal that we need to be looking at the fee simple value. Then from that basis, everything else is going to flow, right? So then we're going to go out and we're going to get our market data. We're going to get specific site information about the property, and we're going to narrow that down and go out and get sales information, rent information, cost information about the subject and comparables. And then based on that, we're going to develop a market analysis, and we're going to reconcile a highest and best use. So again, this it's kind of a big funnel that we're going to flow down to one value. So in the market analysis, there's four types of market analysis that you will see. Well, three that you'll see. The fourth one you may never end up seeing, but let's take a look at what those four levels are. So level A is an inferred analysis. And so basically this is found on small properties in small markets, and the market conditions are stable. So if you've ever had an appraisal on a residential property for lending purposes, there's the form report that they use is called the URAR, and at the very top of the report has information about the property, address, and all that stuff. And it's either the second or third box has a series of check marks about if the market's stable, if it's in balance, things of that nature. That's basically a level A inferred market analysis. Level B is a little bit more detailed. So this is going to have some supply and demand, maybe a little bit more in-depth supply and demand analysis, a little bit more discussion about what the market's doing. And this is used basically if the three criteria, if one of them's false. And remember, the three criteria is small property, small market, and market conditions are stable. So if you had a small property in a small market, but conditions were increasing, then you would have to have a level B market analysis. Level C, this is when two of the three criteria are false. And again, this is going to be more of what you're going to see on a typical commercial and industrial property, right? So you're going to get some kind of national or state discussion. You're going to have some discussion about the local market, and you're going to have some discussion about the property type. And level D, this is a fundamental demand analysis. And in a level D analysis, the appraiser is actually going to forecast in the future, what they, in their opinion, what's going to happen to the market. So, not often are you going to see this in a typical appraisal report. I've only ever done one fundamental demand analysis, and it was on an apartment building that basically they were looking to redevelop part of the apartment because the current configuration of the units weren't what the market was demanding at that time. So again, going to be very uncommon. A lot of times with the fundamental demand analysis also that there's no value opinion developed. There's just a recommendation to say redevelop the property or make some alterations to the property. Again, level A, B, and C are found in the majority of appraisal reports. So then once we go through the market analysis, then we will develop a highest and best use. And again, we're going to develop that highest and best use based on the criteria that we previously discussed. If you're looking at a market value consideration for fee simple, then the highest and best use analysis is going to follow that funnel. So this provides the end of the spectrum of the market analysis. Again, thinking of that funnel, it's going to flow through right into the highest and best use. It's going to determine the most profitable use, the highest and best use, the timing of that use, and the most probable buyer. There are 4 criteria that we look at with the highest and best use: legally permissible, physically possible, financially feasible, and maximally productive. So in the highest and best use, we look at this in 2 different capacities. First, we're going to look at it as what's the highest and best use as if the land is vacant. And then the second one we're looking at is what's the highest and best use as it is currently improved. So again, the 4 criteria is going to follow a funnel. And so physically possible and legally permissible You can actually switch around, but financially feasible and maximally productive must follow the other two. When I'm looking at a when I'm looking at highest and best use analysis, I always look at legal permissibility to begin with, because that's going to take out the most possible uses, right? If the subject is zoned for retail use, then I know I can only use it for retail use, and I'm not going to be looking at apartments or anything of that nature. And then when you get into physical possibility, you're going to look at, okay, I know that I have to have a retail use. Now, what can I physically put on the property? Say, for example, if you have like a 3 acre parcel in a retail district, you could say, okay, well, I could divide this into two 1.5 acre lots, and I can sell those lots off for, say, quick serve restaurants. Or I can develop a neighborhood center on these 3 acres, or say I could develop a single tenant retail center on this lot. And then you're going to be able to eliminate a lot of uses of retail properties that require more than 3 acres. So, a power center, obviously, you're not going to be able to use a regional mall. You're not going to be able to put on 3 acres. A big box store like a Walmart, you're not going to be able to put on 3 acres. And so all those uses are then excluded for further analysis. Then you will take those three uses and consider what the financial feasibility of them is. And so, say, for example, that you know you bought the lot, and you can subdivide it and sell the two lots off for quick serve restaurants. That's a financially feasible use, and you could develop it into, say, a neighborhood center, lease it up, and generate an income um, that would make sense based on the development costs. But say maybe the single tenant retail is not a financially feasible use, and so you're going to exclude that one for further consideration. And then when you get to maximum productivity, you're going to consider all the uses that are financially feasible, and you're going to only select the one use that makes the most amount of money. So, um, say that by subdividing these two um, lots and selling them off for a quick serve restaurant, you can make um, $2 million. But if you develop this neighborhood center at market rents and a market cap rate, the value is $2.5 million. Then we're going to say the maximally productive use is to develop into a neighborhood center. Now, for most appraisal assignments, they don't require such a granular analysis, right? So if it's in a retail district, there's retail development around it, um, then the appraisal is likely going to say the highest and best use is retail development, and it's going to stop at that point. And that's perfectly fine as well. All right. So then once we do the highest and best use as vacant, then we're going to look at the highest and best use as improved. And if we determine that the highest and best use is a neighborhood center on vacant land, and then we're going to look at, okay, what's the highest and best use? Say currently there's a single tenant retail sitting on there, which is not the highest and best use if the ground was vacant. Well, we could say, okay, well, we could retain the existing improvement, we could rent it out, we could make some money based on that. We could convert or renovate it to a multi-tenant, which is more similar to the highest and best use. And then what we would want to analyze at that point is, is, do the renovation costs make sense for the additional rent we could receive? Um, our third option is we could retain the existing improvement as an interim use, or fourth, demolish the existing improvement and redevelop. So for ad valorem purposes, um, most often the highest and best use as improved is going to be concluded to its current use, just because we're looking at an as is value as of the date of value, as of the lien date, January 1st. And if it made sense to uh, demolish, it was financially feasible, the property would have already been likely demolished, right? So again, we're going to use a lot of inferred analysis um, in this step, for purposes of ad valorem, also for like mortgage lending purposes. It's really only right-of-way work, maybe some investment analysis work, that we're going to dive deep into this highest and best use and um, find a potential alternative use. Okay, so then once we develop a land value opinion, then we're going to take a look at the approaches to value, the sales comparison approach, income approach, and cost approach. And then we're going to reconcile value. So the sales comparison approach, basically at this point, we're going to go out and we're going to find sales of similar properties that have been reasonably exposed to the market. They are have a non-motivated buyer and a not atypically motivated buyer and seller, right? All the conditions of market value. They're going to represent fee simple interest. We're going to search, obviously the immediate market area initially, and then we're going to expand that market area based on what a typical investor of that property would do. So, say if you had a local operator mechanic shop, right? Typically, your market area is going to be that town or maybe immediate surrounding towns. If you have, say, a quick serve restaurant, that may be something more regionally that you're going to look at. If you have a regional mall or a power center, those, you may be looking all through the Midwest. So again, you're going to search for comparables from where the buyers and sellers of that type of property come from. Some reminders here on comparables are adjusted to the subject property. So CBS is comps better subtract, right? So in your adjustment grids, if your comps better than your subject, you're going to subtract, and CIA is comps inferior add. So if your comps have an inferior element of comparison, you're going to add. So basically the idea in the sales comparison grid is you're going to take all your comparables and you're going to adjust them to what your subject is. So the next approach is the cost approach. Typically, we're going to use from the appraisal side, Marshall Valuation Services or Marshall and Swift. They can't really decide what they want to be called. They keep changing the name back and forth. It used to be Marshall and Swift cost manual. Then they went to Marshall Valuation Services when CoreLogic bought them, and now I think they're back to Marshall and Swift. So, but anyway, so we'll use that cost manual most of the time. We're going to remove any depreciation, which depreciation can be from physical depreciation, functional depreciation, or external depreciation. Most common commercial and industrial external depreciation is from economic obsolescence. So, say an owner user has built a property, built a building, and the market rent in the area isn't able to support that property. So, it's the new car effect, right? And the functional and external are probably the two most overlooked forms of depreciation because it's really easy to figure out what the age of the property is and apply a life estimate to the property and get your physical depreciation. The functional and external requires a lot more deep dive into market conditions in the property and what market norms and often they change, so um, in our area, Charleston, Illinois, it used to be that students wanted large party houses, basically. You could have 6 or 8 bedrooms. That was the most popular place that would rent 6 or 8 bedrooms with 2 bathrooms in the property. Well, now that market has shifted that every student that has a bedroom, they want a bathroom attached to it. And so these large 6 and 8 bedroom houses with 2 bathrooms virtually are unrentable now because of the shift in market. So then that would be an example of functional obsolescence. And then the final approach is the income capitalization approach. Again, based on the Springfield Marine Bank for assessment purposes, we're going to go out and find what the market rent of the property is, determine a market vacancy and market expense ratio, and we're going to calculate a net operating income and apply a market capitalization. So I think that concludes my presentation. We have a few minutes left here for some questions, if anybody's got any questions. A restricted appraisal. So a restricted appraisal is, basically something less than an appraisal report, right? And so a restricted could be a written appraisal. It could even be just a verbal. But typically, what that is going to be is that there is communication with the client that is under an understanding that they just need a value or they just need some limited information. And so then that is communicated directly to the client. Typically, it's under the understanding at the time the restricted appraisal is submitted that it's not to be relied upon for any other use, right? So it would not be sufficient enough to say go to a PTAB hearing. Wouldn't be sufficient enough to really even go to a board of review hearing. Definitely wouldn't be sufficient enough to go to litigation type situation. So oftentimes restricted use appraisals are used just to see if so like in ad valorem, a restricted use may be used to see if the client has sufficient leverage, I guess, to appeal to the board of review or whatever. So how are the additions or deduction dollar amounts determined to make a comparable property match the subject? So that would be, unfortunately, I've been appraising for 21 years, and still every day doing research, doing basically it's supported with market data. You can go out and survey the market participants and see. You can go out and pull um, data off of market sales to determine, um, you know, one would be regression analysis is starting to get very popular. Um, the problem with regression is that not everybody that's using it understands the requirements that you have to use it. Um, so yeah, there's a wide array of techniques that you can use. Every property type is different. Every market is different. So
All right, if those are the last of the questions, we just want to say thank you for joining us this morning. And our next webinar is going to be on Tuesday, October 7th at 10 a.m. It's Decoding the Cloud, Valuing Data Centers with Ellen Berkshire and Peter Veros. So we hope you'll join us then. Amanda, any last things that I missed?
Nope. Thank you all for joining us. Thank you, Bob, for spending the hour talking with us today. We'll see you next
absolutely.
time.